Welcome back to Wall Street Podcast. Today, we are diving deep into a specific research report, one that's really been making some waves. We're looking at a detailed analysis from Citi Research. It was published July 13th, 2025. And our focus, a prominent name in the luxury jewelry market, Lao Pu Gold, ticker 6181.HK. Our mission, as always, is to pull out the most important insights for you, help cut through the noise, get straight to what matters for your investment understanding.
Right. And Lao Pu Gold, it's interesting. They've carved out this pretty unique high-end niche. They call it heritage gold.
Heritage gold.
Yeah, so it's not your average jeweler. They're combining, modern designs with these classic motifs. They use at least two traditional handmade gold crafting techniques, often embedding diamonds, gemstones, that sort of thing.
Sounds quite specialized.
It is, and it's given them real market leadership. According to Frost & Sullivan, they actually ranked #1 in single-store sales among gold jewelry brands, both 2022 and 2023.
Number one, okay. So they've established this unique, high-performing niche. Now, what's Citi Research making of all this? They've come out pretty strong, haven't they?
Oh, absolutely, and no holding back. Citi's issued a buy rating, and they've also launched what they call a 30-day upside catalyst watch that's set to expire August 13th, 2025.
A catalyst watch, okay. And the numbers, price target.
Significant. Target price is HK $1,084. Now compare that to the July 11 price, which was HK $900.
So quite a bit of upside there.
Exactly. The projected total return, and this includes an expected dividend yield of about 2.4%, it stands at an impressive 22.9%.
22.9%. That's a clear conviction from Citi. And looking at their estimates for the first half of 2025, the 1H25V figures, the growth forecasts are, well, they're just eye-popping.
They really are. Citi is anticipating, get this, 198% revenue growth to RMB 10.5 billion.
Almost 200% revenue growth.
And a striking 260% net profit growth, up to RMB 2.1 billion, just for the first half. These are, well, they're headline numbers for a reason.
Okay, but here's where, for me anyway, it gets really interesting. Their digital strategy. The report highlights an almost unbelievable jump in online sales. Can you walk us through those figures? What's going on there?
Absolutely. This is perhaps the standout number. They expect 500% year-on-year growth in online sales.
100%.
500 to RMB 2.3 billion in the first half of 25. And, this isn't just a big number floating out there. It seems to be backed up. Their Tmall flagship store, for instance, sold 200,000 units just in the past 6 months. And the average net selling price, RMB 11,000 to 12,000. So high-value items online.
That's significant volume at a high price point. What's selling?
Well, the best sellers include things like the gourd pendant and the cross-vajra pendant. And there was a new enamel gourd pendant launched just in May, and it apparently just took off, became a top seller really quickly.
So product resonance is definitely there.
It seems so. And this whole explosion, it's expected to basically double the online sales contribution to over 20% in 1H25E. It really shows how they're kind of redefining how luxury jewelry is sold, tapping into maybe a younger, more digitally native consumer base.
That 500% growth is just staggering. It suggests maybe a successful blueprint for traditional sectors looking to modernize, right?
Oh.
But while online is grabbing headlines, luxury, it often lives and breathes in the physical space too. How are the brick and mortar stores doing?
Yeah, you can't forget offline. And the performance there is also incredibly strong. The report projects 160% growth in offline sales for 1H25E.
Still very strong growth.
Very strong. And if you look at stores operational for over 2 years, the same store sales growth, SSSG, which is key, right? It's expected to be 90 to 100%.
90 to 100% same store sales growth. That's huge for established stores.
It is. And that includes the impact of making stores bigger, improving locations, things like that. Plus, new stores are expected to chip in about 30% of the sales growth because they've increased the store count by about 20% year on year.
So it's a powerful mix. Existing stores doing incredibly well and new stores adding significantly. What about geography? Is the growth concentrated anywhere specific? Any particular stores leading the charge?
Domestically, sales growth is projected at 140%. The 4 SKP stores, those high-end department stores, they're leading the way, 175% growth. They actually contribute over 20% of domestic sales.
Why are they growing faster?
Report says it's due to more promotions in those specific locations, and overseas sales, even more impressive, projected 330% growth.
330%. Yeah.
That's attributed to getting the full period contribution from their 2 Hong Kong stores, one's a large flagship, and also a strong opening performance from a new store in Singapore, which just opened on June 21st.
Okay, so explosive top-line growth pretty much everywhere, online, offline, domestic, overseas. But the crucial question, how does this translate to the bottom line? What about profitability?
Right, profit is key. The net profit margin, NPM, is expected to expand significantly from 16.7% in the first half of 24 up to 20.3% in the first half of 25.
A big jump in margin. How?
It's primarily driven by strong operating leverage. Basically, as sales skyrocket, those fixed costs, rent, admin, etc., get spread over a much larger revenue base, so each sale becomes more profitable.
Makes sense. So they're getting more efficient as they scale up.
Exactly. And this is happening even though the gross profit margin is expected to dip slightly from about 41.3% down to 40.5%. Specifically, the report forecasts SG&A expenses, that's selling, general, and admin, as a percentage of sales to drop from 18.9% in 1H24 down to 13.5% in 1H25E. That's a big efficiency gain.
Okay, so that operating leverage is the real engine behind the expanding net profit margin, a critical sign of, well, good management during growth, looking out further than full-year projections.
Yeah.
How do these efficiencies play out?
For the full year 2025 Citi anticipates RMB 4.7 billion in net profit. That's a massive 220% growth year on year.
220%.
And then for 2026, another RMB 6.4 billion, which is an additional 37% growth on top of that huge 2025 number.
So still strong growth projected into 2026. What about valuation? How does the market see this?
Well, based on those forecasts, the current price to earnings, the PE ratios, stand at about 30 times for 2025 estimates and 22 times for 2026 estimates.
30x and 22x. And Citi's target price, the HK $1,084. What's the thinking behind that specific number? Why do they believe it deserves a premium valuation compared to maybe other global luxury players?
Good question. Citi's target price is based on 36 times that 2025 estimated earnings and a 0.34 times PEG ratio, price earnings to growth.
So a 36 PE multiple, that's punchy.
It is. Their argument is that Lao Pu Gold warrants this premium valuation because of, well, a few things. That rapid growth outlook we just discussed, strong product competitiveness, that heritage gold niche seems to be working, and also the benefit it gets from gold price hikes. It's definitely an aggressive valuation target, but they're backing it up with these fundamental strengths they see.
Okay, so an incredibly bullish picture painted by Citi. Explosive growth, expanding margins, premium valuation justified. But, as always, we need to look at the other side. So what does this all mean for you, the potential investor? Every strong outlook has potential challenges. What are the key downside risks identified in this report? What could derail this forecast?
Right, risks are crucial. The report does highlight several specific ones for Lao Pu Gold. First, volatility in gold prices. That's, pretty standard risk for any jeweler.
Always a factor.
Then there's intense market competition. The luxury space is crowded. And of course, evolving consumer tastes and preferences. Especially in luxury, trends can shift fast. You have to stay relevant. Crucially, there's the potential for consumption trade down. If the broader economic environment gets softer, luxury is often one of the first areas people cut back on. So that's a key macro risk.
Makes sense. Anything company specific?
Yes. The report mentions the company might experience negative free cash flow during this heavy expansion phase. They're investing a lot, which can burn cash short term. And finally, something investors always watch post-IPO. There's potential impact from pre-IPO investors and employees looking to sell shares after the lockup expired. That was at the end of June 2025.
Ah, the lockup expiry. That can create selling pressure, at least temporarily.
Exactly. It's something to be aware of.
Okay, that covers the core report details. Now for our deep comments and questions, let's try to push a bit beyond the surface. First question. That 500% online growth number is attributed to fast penetration among young consumers. How sustainable is that kind of rapid penetration? And does the report imply any specific behavioral or market shift driving this move to online luxury buying?
Well, the report definitely points to this fast penetration as evidence of a successful strategy, particularly with younger demographics. The specifics, like the Tmall sales volume and those best-selling pendants, they suggest the product itself really resonates. Now, the report doesn't explicitly detail why beyond saying fast penetration, but the fact that online's contribution is doubling, that implies a very deliberate and successful digital push. It suggests, a growing comfort level among younger luxury buyers with making high-value purchases online. maybe driven by convenience, digital discovery, or perhaps seeking out those unique designs Lao Pu offers online. Sustainability. That likely hinges on continued product innovation and keeping those digital engagement channels fresh to hold on to that younger audience.
Right, it implies a shift, but doesn't maybe detail the causes of the shift beyond Laipu's own actions.
Mhm.
Okay, next. Citi sees that net profit margin rising because of operating leverage, even though gross profit margin dips slightly. What specific drivers of that operating leverage does the report mention? And how resilient do these efficiencies seem? Could they evaporate if sales slow down?
The report is quite explicit here. It says strong sales to bring operating leverage.
Yeah.
And it gives the numbers. Expects operating expenses, OPEX, to rise 110%, but SG&A as a percentage of sales to drop from 18.9% down to 13.5%. So the driver is clearly that massive increase in sales volume, allowing them to spread fixed costs much thinner. As for resilience, yeah, that's the key point. It hinges directly on continued strong sales growth. If sales were to slow significantly, or if costs rose unexpectedly without matching revenue increases, that operating leverage could definitely reverse and squeeze margins. Citi's bullish outlook clearly assumes that strong growth will continue, underpinning those efficiency gains.
So the leverage effect is powerful, but it cuts both ways depending on the top line.
Got it. Okay, final question. The report mentions a share price correction last week, yet Citi maintains its buy rating and that significant upside target. How much does Citi's positive outlook factor in that recent market volatility, especially considering the lockup expiry risk you mentioned earlier? Yeah, they address that directly. The report states, and I'm quoting loosely here, after the share price correction last week, the stock now trades at PE of 30 by 22 by 2025 E26E. Maintain buy. So that explicitly tells us their buy rating and that HK $1,084 target are based on the valuation after that recent dip.
So they're saying even after the drop, it's still a buy with significant upside.
Precisely. It suggests they see the correction as maybe overdone or that the fundamental story outweighs the short-term volatility. The lockup expiry risk. It's listed clearly as a risk factor, so it's acknowledged it's something for investors like you to consider. It could cause some temporary selling pressure. But the overall analysis, the sum of all parts according to Citi, still points towards a buy based on those strong fundamentals and the growth trajectory they foresee.
Understood. So they're aware of a volatility and the lockup risk, but the core growth story keeps them positive.
That seems to be the takeaway from their analysis, yes.
All right, so today, we've really unpacked Citi's detailed preview on Lao Pu Gold. We've seen this picture of significant growth driven by smart strategic plays. We've seen how a unique market position, that heritage gold idea, coupled with really aggressive expansion both online and offline, can project these remarkable financial results. What stands out to you from all this? Maybe consider how a company's unique positioning, when combined with that aggressive digital and physical expansion, can really shake up a traditional sector. And think about what that might mean for your own investment thesis, not just in this stock, but maybe more broadly. Thank you for joining us for this deep dive. We look forward to our next one.